We would like to take this opportunity to introduce you to one of the last bears out there. Stephanie Pomboy, president of MacroMavens. Just when everyone has been talking up recovery, she's been pointing out such things as the jobless rate is high, inflation is creeping up, and yes, housing remains in trouble in certain areas. So welcome, Stephanie Pomboy. Good to have you with us. You're not buying any of this recovery, are you?
I'm not. You know, it was so nice of you to let me crawl out from my bear cave for this temporary
we're glad to have you here. So let's talk about inflation right now for the first part, because I know you want to make the case about asset price inflation. We're seeing the increase in financial prices of things like stocks.
Right.
Is that where we're getting the inflation in the economy?
I think so. I mean, I think there's been understandable consternation about where all of the Fed's surplus liquidity is going to eventually flow, and the idea that it will take root in the economy and we'll have some kind of Weimar Republic style inflation. And I just have a very hard time squaring that with what we're seeing in terms of the deleveraging of household balance sheets. You know, absent credit, what are consumers going to use to absorb these higher prices? If you have a $100 budget and the price of gas goes up $10, strikes me you got $10 less to spend on everything else.
That sounds way too simple for what goes on in the stock market these days. So, all right, so this idea that the consumer is still quite strapped for money.
Yes, and actually I was just, reading through these various consumer surveys, one including conducted by Bloomberg, where consumers say, we don't intend to spend more. Quite the contrary. More consumers are talking about cutting back as, if you want to call it, the new normal. They're adjusting to a lower level of consumption. And that squares with what we're seeing in terms of the monthly retrench on consumer credit. If job growth isn't going to provide income and people aren't going to borrow, then they have precious little money with which to absorb a generalized rise in prices. So what I see is an environment where the price of stuff people can't live without continues to go up, as has been the case, for the last several years, but that effectively crowds out inflation in the discretionary areas. But in a much broader analysis, what we're talking about is money that's not being used by the economy for whatever reason that's now free to slosh into financial assets. So if and when the supply of money or credit begins to expand, you get into this environment where marginal liquidity can flow either to assets or the economy. In an environment where the economy is not demanding that marginal dollar, sure, stocks go up, commodities go up, everybody's enjoying the ride. So the question is how long that can be sustained.
Well, you took my next question, which is how long can a marginal liquidity-driven rally, how long can something like this go on if indeed the government officials, whether it's Federal Reserve Chairman Ben Bernanke or indeed Treasury Secretary Timothy Geithner, remain committed, and we know they're going into this G20 meeting, remain committed to keeping the spigot open and keeping the funds flowing. How long could this go on? Yeah. Indefinitely?
This is one of my sort of latent weaknesses, is that I always believe in the triumph of the fundamentals, and I keep watching these bubbles inflate, and I say to myself, at some point the fundamentals will trump all. And I think the last time we were here we were talking about the expectation for corporate earnings, which was really built on ultimately getting top line revenues, which so far they have failed to produce. How many more quarters will investors grant them sort of a stay of execution on that? Okay, you didn't get top line this quarter, maybe next quarter.
But you cut so much, you did pretty well on the bottom line.
Exactly. They were beating their, downbeaten expectations by a penny by cutting costs where they couldn't, pick up top line revenues. But so I continue to sort of sip my own Kool-Aid that eventually those fundamentals will be, undeniable, and they will trump this liquidity wave. I believe that to be the case for sure here in the U.S., where things have gotten so extended. At least in the emerging economies, there are indications of growth that might support or in some way justify the move.